Good afternoon. Thank you very much for attending our webinar today on how to predict the future. My name is Andrew Talbot and I work for GlobalEye. Specifically, the webinar should only be about 15 minutes long, maybe 20 or so. If you have any questions, then we'll be in touch afterwards, or feel free to contact us on some of the details on the screen, and they'll be repeated at the end of it as well. We're recording the webinar, so we'll be able to send it through to you afterwards, so that you have it for your own information purposes. So today we are going to talk about cash flow forecasting and how it impacts on your financial planning. It can be, let me just try and bring it up. Cash flow will impact all of these different areas: retirement planning, investment planning, protection, mortgage planning, estate, before and after retirement. It really depends on every single aspect of what you're trying to achieve. And really, the cash flow is to say, look, do I have enough money to achieve these particular goals now and in the future? So it's very important. It really is the basis of financial planning. Some financial planners around the world say that you can't really give advice or give a plan unless you're really taking into account this factor. So what is it? Really, it's just saying, look, you need to take everything you have, all of your assets and liabilities, assess them, write them down, find out what you've got. Include all your income and expenditure. So what are you likely to earn in the coming years? What are you going to spend? What is your potential factors on the horizon that are going to impact on your expenditure? So school fees, retirement, everything else that we just talked about earlier before. I want to buy a house. I want to buy a new car. I want to go on holiday. And then you set your goals. So you could say, I want to go on holiday twice a year, or I want to send my kids to a university in the US over the UK or Australia. I want to retire to Bali. I want to have all of these. These are my goals. I want to buy 3 properties. I want an income from those to supplement my income. It's really saying, look, what do you want to achieve? And then we try and work out how we can do that. You need to include all of the future changes in the situation that might happen. You need to assess all the economic conditions. A little tricky as per yesterday with the US elections, but understanding, is there going to be a growth cycle coming up? What is the inflation targets? Is this going to impact on whether or not my wages or my salaries are going to grow? It should be taken into account. And then you're identifying whether or not there is a shortfall or a surplus. Can you fund your retirement? Can you send your children to university in the US, or do they have to go somewhere else? And then that's what we do. We explore the what if scenarios. What happens if you were ill? What happens if you decide to change your job? You want to become a consultant. You want to work part-time. You want to take time off to look after the children. What happens if the tax rates increase because you've changed countries? What happens if you're now suddenly paid in a different currency, or you've moved to a different area? All of these should impact the planning that you want to do. And this is how cash flow will try and give you a forecast. In the end of it, we produce a plan so that you can see it, you can adjust it, you can change it. And it really does make sure that you achieve what you want to achieve. You need to consider the individual goals though. This is very important. So if you took your life, for instance, a fictional position, age 28, you have your first son. Age 52, they graduate, obviously very proud. Age 65, vacation in Australia, the wife. And then at age 80, you want to be a dessert chef. So you've changed your life, okay? So you need to be able to say, look, can I fund that? Do I have enough savings to do that? Have I saved enough for this? Has my growth rates on my investment portfolio achieved what I wanted to do? Or did I take too much risk? So consider each goal in more detail. The wealth management side is, look, consider the specific goals. Do the risk levels. Am I optimizing returns? Am I paying enough? Am I paying too much tax? What happens if I'm become ill or I get critical illness? How is that going to impact on whether or not I can achieve what I want to do? And then in retirement, it's a similar. How much do I want in retirement? How am I going to take it? The tax optimization is very important, certainly as an expat, because you're not sure which country you're going to be in. You might be in 2 countries, therefore you might say, well, I have to spend enough time in one country to minimize the tax there. Otherwise, if I go into a high tax jurisdiction, such as Europe, Australia, US, then they can be very different to being in maybe parts of Asia or the Middle East, or immature tax jurisdictions, as we call them. And where are you going to get that income from? Are you going to sell your property or downsize because there's a lot of equity in there? Have you earmarked a particular pension scheme for retirement? Or have you said, look, I'm going to take a small business and I'm going to sell it because that is my retirement? And you're trying to say, well, what's the risk level of it achieving its goals? Everything that takes into account a financial plan. The big impact is assumptions. Now, these are the factors that will make a difference to whether or not you will achieve what you want to. The investment return on your portfolio, you may say, well, I can get double-digit growth every year for the next 10 years, at which point I'll be able to hit my goals. Is that realistic in today's economic conditions? It might be, it might not be, but you need to be able to assess that, okay, what happens if I only get 2% or I get a loss this year? How is that going to impact on whether or not I can send my kids to university in the US or reduce my income because I want to be a consultant? Same with price inflation. At the moment, the prices around the world of inflation is generally very low. The governments or the central banks are trying to pick up the growth and keep the inflation or increase the inflation. At the moment, you could pick an inflation rate, and obviously it depends on where you are in the world. But in a year's time or 2 years' time, it could be very different to what it is today. The central governments hope it's going to be very different. And this has an impact the same on your wages or your salaries. A lot of people haven't necessarily received increases in their salaries over the last couple of years because of the economic situation. Is that going to increase in the future? If, for instance, you're saying, right, well, I need to save 12% of my salary every year into retirement funds, but it needs to increase 2 or 3%. Will I hit the goals? What happens if it doesn't increase? Those are the factors that you need to consider. And it's really the same with in retirement. What are the annuity rates? Now, I know it doesn't necessarily mean that you're going to have an annuity, but annuities are generally based on the government bonds or corporate bonds. At the moment, gilt rates are very low, US Treasury rates are very low, ECB are very low or negative even. So how are you going to generate an income from those effectively low risk assets? Are we going to get a yield from corporate bonds? Those are the factors that will determine an annuity rate or an income that you receive in retirement. Your current portfolio will also need forecasts. You may be 100% into gold, at which point you probably did okay yesterday, or you might be 100% in equity or have a mixture of the two. It really depends on what are those forecasts for that investment. We'll come on to details later on about really how far you should go into it. The big one is risk. If you're trying to achieve, as we said at the start, 10% investment return, then you're going to have to take a reasonable amount of risk in order to achieve that. Not necessarily mean you're going to get that every year. You might get -5 in 1 year. If you can plan that into your cash flow to say, right, well, if I achieve 3 years of negative growth, then I need to stay in the market because I need to get that double-digit growth because that's how the cycle's gone, because that's my risk profile. Then it's very important that you understand how that will impact on your goals. The big one for expats tends to be, well, where am I likely to be? Um, Generally, as an expat, you've traveled around the world. Your kids are in different universities or schools around the world that maybe lived in different countries. Is that likely to continue in the future? At which point, what's the currency that you're going to be spending your money in? If you're earning dollars, US dollars, and you're going to be in Australia, then you're going to need Australian dollars, or you're going to need UK pounds, or euros, um, or you're earning Singapore dollars. They need to be taken into account. And obviously, we've talked about the tax systems. Australia, UK, US, very high tax compared to elsewhere. How is this going to impact on your finances? And then investment models. So there's two different investment models that we like to use, and they help you with the assumptions. The first one is deterministic, an overall view on modeling, and the second one is stochastic, which is a detailed view. Now, obviously, as a financial planner, I really like the stochastic because it's more detail. It can have a more accurate figure on whether or not your investment portfolio will grow. And really, if we took an overall view, saying deterministic is saying, well, I've got to have 60% in equity and 40% in bonds. Where stochastic will say, well, where is the equity? What geographical location is it? What sector is it? What is the growth rate in those particular areas, or for that particular investment? How is that going to make a difference going forward? So you're taking more of a rational view of your investments, and you're going into a more detail, trying to project an accurate view of where the investment portfolio is likely to be. I think deterministic, or just having a very general overview, is a good start, but I think we should be saying, well, how far can we go? How accurate can we go to make that difference and get a better understanding of our finances? So what are the things that you should consider whilst planning? There's lots of different areas, and these questions and these areas could go on all day. So these is a quick example, or some of the reasons that you need to think about. Generally, how long have you got to until the point that you need the money? I am 40 today and I'm going to retire at 55. So you got 15 years. What's your income going to be in 15 years? What are your expenditure going to be? How long are you going to live for? It's very difficult to say that, but mortality rates around the world are extending, and the demographics of people are that they are living longer. So whereas before you would have maybe passed away into your 70s or into your 80s, now it's really going to say, well, I've got to make my assets last until I'm 90 or 100. And as the demographics change, then your healthcare costs are certainly going to go up in retirement. Because your children live all around the world, you're probably going to have more flights to them than necessarily going to live in the country or just around the corner from where you are. How much should I save for education? Well, if you're going to send your children to university in the US, that's going to be certainly a lot more expensive than if you sent them to somewhere in the UK or Australia. You've got to understand, well, what is the difference between those, and how much is that going to cost me? Where do I want to retire? As we touched on it, different tax systems, currencies, and really it's a case of how much do I need? That's the big one. If you need 2,000 or 3,000 in retirement and it's going to last you 50, 60 years, then you're going to need $750, $1 million in order to provide that income. And that's really taking into account, well, what assumptions am I doing on how much am I going to take from that? Do I want to leave a legacy to my children or my grandchildren? The biggest fear people always have is they run out of money in retirement. And some of the things that can impact that is, what happens if I get ill? What happens if I have a critical illness? How is that going to impact on my finances? So really a case of what do you need to do next? Well, this is a financial planning software that we use. It's very accurate in trying to predict the impact of inflation and wage increases, the tax rates around the world, different currencies, what's the most tax efficient way of reducing the burden of that on retirement or at certain levels. So in this scenario, the blue graph is the income that this person is receiving into up until the point that he retires. The black line is his needs. That's what his expenditure is. At retirement age, it's very extreme, but that actually drops off a cliff. So whereas his savings investments, what is his pension? Is it a particular pension scheme that's going to provide that? Or is it a business? Is it a state security, such as a basic state pension, or CPF or something along those lines? Where is that all going to come from? And you're saying, well, what happens if the inflation will increase? So that total needs black line will suddenly jump up. Have you paid off your mortgage by the time you retire? Therefore, you've got no mortgage or property costs. And it all impacts on the retirement fund. So as we discussed before, savings, pension, portfolio, and obviously the property. Putting it all in a plan or a very good piece of software will be able to let you see where you are with your finances now. An Excel spreadsheet will do the same. It has to be very detailed. And as we talked about with the stochastic rather than deterministic on investment returns, you really need to say, well, do I need someone to help me with this? How complicated are my finances? How much do I want to see whether or not I'm on target to hit my retirement or my education fees, or the fact that I want to buy a house in 5 years' time, I want to buy another house, or I want to generate an income. So in summary, identify what you've got already, your assets, your liabilities, your income, your expenditure. Work out what you want to achieve. I want my children to go to university in the UK. I want to be able to leave them a legacy if something happens to me. I want them to be able to give them a deposit on a house when they hit 25, or I need to retire on this amount. Include all your assumptions. Now, these are the very important parts. We talked about it: interest rates, investment rates, wage inflation, price inflation, the growth of particular assets. How is your portfolio structured? And then you build the plan. You get your graph, you get your numbers, you see whether or not there's going to be an income surplus or there's going to be a deficit. At which point, do you need to adjust those goals, or do you need to fund your education fee plan or your retirement fee? Or do you need to say, look, I need to cut down on my expenditure? And then every year we review it, change those assumptions. How's it looking? What is the position going to be like? Because the economic situation has changed. So it's all very important to consider all of these different factors. And just to finish, we'll go on to some of the facts and figures that you may know, you may not know. In the US, 25% of people over the age of 55 have no retirement savings. Women are less prepared than men for savings and retirement. UK, 44% of the country is a non-saver. And then the pensioner poverty, where is it most prevalent? But if you look at these countries, it's because the demographics of them are that they are living longer and longer. So the assets they may have built up over their lifetime may have been able to sustain them for maybe 5 or 10 years. But as their medical advances have happened, people are being able to live longer, their health care costs are increasing. And Korea, Australia, US, and Japan are areas where there is a longer demographic. So it's very important to think about that. So thank you very much. For more information, please contact us on the details below, and we'll be in touch. And we'll be able to take you through your own individual circumstances, and may be able to help you in that respect. So thank you very much, and we'll be in touch soon.